Have you ever wondered how someone becomes not just a billionaire, but a legend in the world of finance? Today we're peeling back the layers on the one and only Warren Buffett, but we're not just talking about his billions. We're going back to the very beginning to uncover the fascinating story of how a young boy from Omaha, Nebraska, made his very first $1 million. This isn't just a story about money. It's a masterclass in mindset, patience, and a deep understanding of value that started when he was just a kid. Forget the complex charts and jargon for a moment. We're diving into the fundamental principles and the surprisingly simple, yet brilliant early steps that paved the way for the Oracle of Omaha. It all started long before Wall Street even knew his name. Picture this, a 6-year-old Warren Buffett going door to door in his neighborhood. What was he selling? Not lemonade, but packs of chewing gum. He'd buy a multi-pack from his grandfather's grocery store and then sell the individual sticks for a small profit. A tiny venture, right? But it was his first lesson in a core principle: buy low, sell high. He quickly moved on to buying 6 packs of Coca-Cola for 25 cents and selling each bottle for 5 cents, pocketing a nickel of profit on every 6-pack. He wasn't just a kid trying to earn pocket money. He was a tiny businessman learning about margins, customer demand, and the power of compounding small gains. While other kids were playing, Warren was discovering the magic of making money work for him. This entrepreneurial fire was lit early, and it would only grow brighter. He wasn't just earning, he was learning, observing, and calculating. These weren't just odd jobs, they were his first case studies in business. As a teenager, his ventures became more ambitious. He had a paper route delivering the Washington Post, but he didn't just deliver papers. He optimized his routes for maximum efficiency and started selling subscriptions, calendars, and other items to his existing customers. He understood the concept of customer lifetime value before it was a business school buzzword. He was essentially upselling and cross-selling, maximizing the revenue from each household on his route. By the time he was 14, he had saved up $1,000, which is over $15,000 in today's money. With this capital, he invested in 40 acres of Nebraska farmland, which he then leased to a tenant farmer. He was already diversifying his income streams: active income from his paper route and passive income from his land. Think about that for a second. As a teenager, he was already a business operator and a landlord. This wasn't luck. It was a deliberate strategy of saving, investing, and expanding. But the real game changer was his discovery of the stock market. At just 11 years old, he made his first stock purchase. He bought 3 shares of a company called City Service for himself and 3 for his sister, Doris, at about $38 per share. The stock quickly dipped to $27. Warren felt immense pressure, especially since he'd involved his sister's money. He held on nervously. When the stock rebounded to $40, he sold immediately, making a small profit. He was relieved, but his relief turned to regret almost instantly. He watched as City Service shares skyrocketed to over $200. This experience taught him one of his most famous and enduring lessons: patience. He learned that short-term market fluctuations can be deceptive, and that selling a good company for a small, quick profit can be a huge mistake. It wasn't about timing the market, it was about believing in the long-term value of the business you own. This early sting was perhaps the most valuable financial lesson of his young life. Another pivotal moment in his youth was his pinball machine empire. At 17, Warren and a friend bought a used pinball machine for 25 O's. Instead of putting it in an arcade, they approached a local barber and offered him a deal. Put the machine in your shop and we'll split the profits 50-50. The barber agreed. Within hours, the machine was filled with quarters. The concept was a massive success. So what did they do? They didn't just spend the profits, they reinvested. They used the money from the first machine to buy a second, then a third, and soon they had a network of pinball machines in barbershops all over Omaha. This was the principle of compounding in action. He called the venture Wilson's coin-operated machines. And when he eventually sold the business a year later for over $200, he had learned a powerful lesson about scalable business models and the incredible power of reinvesting your earnings to fuel exponential growth. Now, a lot of people think Buffett was born a genius, But a huge part of his success came from his insatiable appetite for learning. He famously read every book on investing in the Omaha Public Library by the time he was a preteen. He was obsessed. But the turning point came when he discovered a book called The Intelligent Investor by Benjamin Graham. For Buffett, this was an epiphany. Graham's philosophy of value investing, buying stocks for less than their intrinsic worth, treating a stock purchase as buying a piece of a business and demanding a margin of safety, resonated deeply with him. It provided a logical, business-like framework for the ideas he had been developing on his own. It was so transformative that, after college, Buffett specifically went to Columbia Business School just to be taught by Benjamin Graham himself. This mentorship was crucial. Graham didn't just teach him a method, he gave him a rigorous, disciplined, intellectual foundation that would guide every investment decision he made for the rest of his life. After graduating and working for his mentor Benjamin Graham for a couple of years, Buffett returned to Omaha in 1956 with about $140,000 in personal savings, which is over $1 million in today's dollars. At 26 years old, he was ready to start his own firm. He launched Buffett Associates Limited. So how did he get from there to his first million? Through relentless application of these principles. The partnerships he formed were wildly successful. While the Dow Jones Industrial Average had its ups and downs, Buffett's partnerships delivered consistently spectacular returns, year after year. For example, in his first 5 years, he grew his partner's capital by over 250%, while the Dow grew by only 74%. He was a master at finding what he called cigar butt companies, businesses that were on their last legs but had one final profitable puff left in them. He would buy them, liquidate their assets, and reap the rewards. He also invested in stable, predictable businesses like the Dempster Mill Manufacturing Company. Through these carefully selected investments and the power of compounding returns within his partnerships, his personal net worth grew rapidly. By 1962, just 6 years after starting his firm, Warren Buffett's personal stake in the partnerships had crossed the $1 million mark. He was just 31 years old. So, when we look back at the journey to that first million, what's the real story? It wasn't one single lucky bet. It was a culmination of habits and principles established in childhood. It was the discipline to save and live frugally, even when he started making good money. It was the entrepreneurial drive to always be starting new ventures. It was the intellectual curiosity to read everything he could and learn from the best. It was the patience he learned from his first failed stock trade and the power of compounding he learned from his pinball empire. And most importantly, it was the unwavering commitment to a clear investment philosophy, value investing. He became a millionaire not by chasing quick riches, but by methodically, patiently, and brilliantly buying good businesses at fair prices. The story of Warren Buffett's first million is the foundation for everything that followed. The principles he used to turn a few $1,000s into $1 million are the very same principles he used to turn that million into tens of billions. It teaches us that success in investing isn't about being a Wall Street wizard or having a crystal ball. It's about having the right temperament, a long-term perspective, and a solid logical framework for making decisions. It's a powerful reminder that the biggest oaks grow from the smallest acorns, and that the path to wealth is often paved not with genius, but with discipline and patience. Thank you so much for joining me on this deep dive into the early life of a legend. I hope you found it as fascinating as I do. If you enjoyed this story and want more content that breaks down the secrets of success, please hit that like button and subscribe to the channel. Let me know in the comments which business icon you'd like me to cover next. Thanks for watching, and I'll see you in the next video.